Welcome to my channel, where we unravel the mysteries of the stock market. Let's dive in. Ever wondered how to read and understand candlestick patterns in the stock market? Well, you're not alone. These intriguing visual representations, originating from Japan in the 17th century, have become a staple of modern financial analysis. Candlestick patterns provide a vivid picture of market sentiment, offering valuable insights into potential market reversals and continuations. Understanding these patterns is akin to learning a new language, the language of the market. It's a skill that can spell the difference between a successful trade and a missed opportunity. Each candlestick tells a story of struggle between buyers and sellers, of hope and of triumph and defeat. In the world of trading, knowledge is power. And the knowledge of candlestick patterns can empower you to make informed decisions based on the collective emotional state of the market. So, are you ready to unlock this powerful tool in your trading arsenal? Now let's dive deeper and understand the anatomy of a candlestick. To comprehend candlestick patterns, we must first understand the basic structure of a candlestick. Let's picture a candlestick as, well, a candle. It has a solid body, and it can have one or two wicks extending from it. The body of the candlestick represents the range between the opening and closing prices during a specific period. If the body is green, it means the closing price was higher than the opening price. This indicates an upward trend in the market, a bullish sentiment if you will. But if the body is red, it implies the closing price was lower than the opening price. This is a sign of a downward trend, or a bearish sentiment. Now let's talk about the wicks. The wicks are the thin lines extending from the top and bottom of the body, reaching out to the highest and lowest prices traded during the same period. The top wick represents the highest price, while the bottom wick shows the lowest price. So, if you see a candlestick with a long upper wick and a short lower wick, it suggests that the prices rose significantly before falling back down, indicating selling pressure. Conversely, a candlestick with a short upper wick and a long lower wick indicates buying pressure, as prices dipped but then rebounded to close near the opening price. The length of the body and the wicks can provide valuable information about the market's sentiment. A long green body signifies strong buying pressure, while a long red body indicates strong selling pressure. Similarly, long wicks can signal a potential reversal in the trend, as they show a strong push by either buyers or sellers that ultimately didn't hold until the close. The beauty of candlestick charts is that they present all this information in a visually intuitive way, making it easier for traders to understand the market dynamics and make informed decisions. With this basic understanding, we can now move on to identify various candlestick patterns. Some crucial market sentiments can be understood by observing just a single candlestick. This is the power of single candlestick patterns. They are like the alphabet of the stock market language, and today we're going to learn a few of these letters. First up is the doji. Picture a cross or a plus sign. That's what a doji looks like. It's formed when the opening and closing prices are virtually the same. A doji represents indecision or a struggle for positioning between buyers and sellers. When you spot a doji, it's a signal that a reversal might be on the horizon. Next, meet the hammer. This pattern has a small body and a long lower wick, looking somewhat like a hammer. It forms after a decline and signals a potential bullish reversal. When you see a hammer, it's as if the market is saying, hey, it's time to pick things up and build some momentum. Then we have the hanging man. Despite its ominous name, a hanging man is simply a bearish counterpart to the hammer. It forms after an uptrend, and it may imply that sellers are starting to outweigh buyers. It's like the market whispering, the party might be over soon. Let's imagine a stock that opens at $20, rises to $25, falls to $15, and then closes at $20 again. That's a doji. It shows a tug of war between buyers and sellers with no clear victor. Now consider a stock that opens at 20, falls to 10, but then bounces back to close at 20. That's a hammer, indicating the buyers have taken control and a bullish trend might be brewing. Finally, if a stock opens at 10, soars to 20, but then plunges to close back at 10, you've got a hanging man. It suggests the sellers are gaining ground and a bearish trend could be coming. These single candlestick patterns can provide valuable insights, but the story gets even more interesting when we start to look at multiple candlestick patterns. So stick around to delve deeper into the fascinating world of candlestick patterns. Multiple candlestick patterns can offer a more comprehensive view of market sentiment. To start, let's discuss the bullish engulfing pattern. This occurs when a small red candlestick, representing a price decline, is followed by a larger green candlestick, representing a price increase. The body of the green candlestick completely engulfs the body of the previous red one. This pattern indicates that buyers have entered the market in force, overpowering sellers and potentially signaling a market reversal from a downtrend to an uptrend. On the flip side, we have the bearish engulfing pattern. It's essentially the mirror image of the bullish engulfing pattern. A small green candlestick is followed by a larger red one, with the body of the red candlestick completely engulfing the body of the previous green one. This pattern suggests that sellers have seized control, potentially signaling a market reversal from an uptrend to a downtrend. Now let's move on to the morning star pattern. This is a three-candlestick pattern that starts with a long red candlestick, followed by a small-bodied candlestick that gaps below the first one, and ends with a long green candlestick that closes above the midpoint of the first candlestick. This pattern is often seen at the end of a downtrend and signals a potential reversal to an uptrend. The evening star pattern is the opposite. It begins with a long green candlestick, followed by a small-bodied candlestick that gaps above the first one, and ends with a long red candlestick that closes below the midpoint of the first candlestick. This pattern typically appears at the end of an uptrend and signals a potential reversal to a downtrend. Let's imagine we're analyzing the stock of a hypothetical company. If we see a bullish engulfing pattern, we might consider it as a signal to buy. Conversely, a bearish engulfing morning star or evening star pattern could be a signal to sell or short the stock. So, by understanding these patterns, one can anticipate potential market reversals. Knowing the patterns is just the first step. Applying them to real-world trading is where the real challenge lies. Candlestick patterns, as you've now learned, are a powerful tool for understanding market sentiment. But how do traders put this knowledge to practical use? Let's delve into that. Consider this. You've identified a bullish engulfing pattern on your daily chart. This is a strong buy signal, right? Not so fast. Experienced traders know that candlestick patterns should never be used in isolation. They are most effective when combined with other technical analysis tools. For instance, you might want to look at the volume data. A bullish engulfing pattern accompanied by high trading volume is a much stronger buy signal than one with low volume. Similarly, if this pattern occurs at a known support level, it adds further weight to your decision to buy. Now let's flip the coin and talk about the perils of ignoring these patterns. Imagine you've been riding a bullish trend, enjoying a nice upward trajectory in your stock. Suddenly, a bearish harami appears on your chart. If you choose to ignore this pattern, believing the uptrend will continue unabated, you might be in for a nasty surprise. The bearish harami is a warning sign that the trend may be about to reverse. Ignoring it could lead to potential losses if the price starts to plummet. Another key point to remember is that candlestick patterns are more reliable over longer time frames. A doji pattern on a 15-minute chart may not hold as much significance as one on a daily or weekly chart. And finally, always keep in mind that while candlestick patterns can give you an edge, they are not foolproof. Market conditions, news events, and a host of other factors can influence price movements. Therefore, it's essential to manage your risk appropriately, using stop losses and take profit levels strategically. Remember, candlestick patterns are just one tool in a trader's toolkit. They should not be used in isolation, but in conjunction with other market analysis techniques. So keep honing your skills, stay vigilant, and may your trades always be profitable. In our journey through the fascinating world of candlestick patterns, we've covered a lot of ground. We've delved into the anatomy of a candlestick, identified single and multiple candlestick patterns, and explored their practical application. But, as we've stressed throughout, these patterns are not the be-all and end-all. They're one tool in a trader's toolkit, and they're most effective when used in conjunction with other market analysis techniques. So, what are the key takeaways? First, remember that candlestick patterns can provide valuable insights into market sentiment. However, they should never be used in isolation. Second, these patterns are more reliable over longer time frames. A pattern on a daily or weekly chart holds more significance than one on a 15-minute chart. Third, always pay attention to volume data and known support and resistance levels when interpreting these patterns. And finally, always manage your risk appropriately. Use stop losses and take profit levels strategically. The market is unpredictable, and while candlestick patterns can give you an edge, they are not foolproof. So keep honing your skills, stay vigilant, and always be ready to adapt to the ever-changing market conditions. That's all for today, folks. Thank you for watching. If you found this video helpful, be sure to hit the like button and subscribe for more insightful content. Until next time, may your trades always be profitable.